When it comes to total returns in 2023, there just happens to be some ETFs that totally hit the bullseye. Hold on to your seatbelts, folks. This is going to be a good one. With total return investing, it can be very easy to get caught up in all the great stocks that are available for our investing buck. However, ETFs are also a very viable approach to total investing, as there are some superstars out there that are not only beating the TSX, but are also putting many of our favorite blue chip companies to shame. These exchange-traded funds can be a huge complement for a total return portfolio, and not just for that total growth. They can also add with diversity and can provide a level of protection as the managers of the funds rebalance when they find one of the companies they are invested in are just not pulling their weight. One concern when you're investing in ETFs is that you're going to see this thing called a management fee, or perhaps a management expense ratio, also called an MER. A management fee is simply a fee charged by the manager of the fund to, well, manage the fund, and it will come in as a percentage on that ETF. This fee is paid directly out of the asset's value, so when you get a return, the fee is already deducted. The management exchange ratio is a broader measure that includes the management fee and all other expenses associated with running the fund. Same idea, it is all deducted from the value of the asset before you receive any returns. You definitely don't have to worry about these fees showing up on your brokerage. However, in a nutshell, it is good to keep an eye on what you are being charged, as those fees can add up once you take into consideration the compounding effect on them over longer time frames. Join the conversation. Let us know in the comments if you have a favorite ETF. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. When it came down to putting together this list, I did exclude any ETFs that use leverage, which will eliminate inverse ETFs, for example, and a few others using leverage to enhance their returns. We are basically looking for those less complicated ETFs for this one. So without any further ado, let's do this. Kicking off this list, we have the Fidelity International Value ETF with a ticker of FCIV. They are based out of Toronto, and this ETF aims to provide exposure to international, non-US value stocks focused on companies that appear, well, to be undervalued. Their current price comes in at $32.29. Their NAV comes in at 30.42. They have net assets of 150.45 million. They've got a pretty stable beta of 1.08. Their price to earnings ratio, that comes in at 7.64, and they have a return on equity of 18.75%. Now that management fee we talked about earlier, that comes in at 0.45%. When it comes to dividends, they do have a dividend yield of 3.671%. It is a semi-annual dividend, so twice a year you get paid out 81.7 cents per share. When we look at their returns, on their 3-year return on investment, it comes in at 23.29%. Factor in the dividends, we do get a total return of 34.18%. And year to date, 2023, their return on investment comes in at 13.62%. Factor in the dividends, and you do get a total return of 16.49%. This is great for getting some international exposure in your portfolio, and the return is not too bad either. Coming in at number 4, we have the CI First Asset Japan ETF with a ticker of JAPN. They are based out of Toronto, and this ETF is designed to provide investors with exposure to equity securities of companies located in, well, Japan. Their current value comes in at $39.39. Their NAV comes in at 39.29. Their net assets come in at 780.13 million, and they've got a very stable beta of 0.59. Their price to earnings ratio, that comes in at 10.37, and they have a return on equity of 14.14%. Their management fee, nice and low, 0.48%. Now this one is the only one on today's list that has no dividends, so we'll skip right to their returns. Their 3-year return on investment, it comes in at 64.67%, and this year, 2023, year to date, that return on equity comes in at 37.58%. Not too shabby. The Japanese market is stronger than most people give it credit for, and this ETF is, well, it's the proof in the pudding. Taking our third spot, we have Tech Giants Covered Call ETF with a ticker of TXF.B. They are also based out of Toronto, and they invest in the 25 largest technology companies in North America and use covered calls to enhance their returns even further. Their current price is $22.97, and they have an NAV of 20.41. Their net assets come in at 64.32 million, and they've got a beta of 1.20. Their price to earning ratio, that comes in at 34.03, and they have a return on equity of 27.75%. That's a very good one. I like that number. Their management fee is a little bit higher, 0.65%. Now, because of those covered calls, they've got a pretty good yield. That yield comes in at 8.087%. It is a quarterly dividend of 47.3 cents per share. When we look at their returns on the 3-year, the return on investment comes in at, well, it's not that great, 2.64%. Factor in the dividends, we get the total return of 4.37%. Now, year to date, though, different story. Year to date, that return on investment comes in at 43.47%, and we get a total return of 55.10%. That's pretty darn good. This ETF has benefited big time from, well, the AI boost in the tech sector. I do believe that AI boost is not over yet, so this bodes well for this ETF. At number 2, we have the Horizons Global Uranium Index ETF with a ticker of HURA. They are also based out of Toronto, and they try to replicate the performance of the Selective Global Uranium Pure Play Index. Their current price is $35.25, and their NAV comes in at $35.23. Their net assets comes in at $75.55 million, and they have a pretty stable beta at 1.08. Their price to earnings ratio comes in at 23.57, and their return on equity comes in at 6.28%. Their management fee, a little bit on the higher side, 0.75%. When it comes to dividends, they don't pay a lot out. We get a 0.905% yield, and they only pay once a year annually, so 31.9 cents per share. However, the story on this one is with the return side. When we look at that 3-year return on investment, it comes in at 177.56%. Factor in the dividends, we get 183.06%. Holy banana bread, that's not bad. Their year-to-date, 2023, that return on investment comes in at 59.94%. Factor in the one dividend they're getting, and it's 61.38%. That's really good. These numbers are fantastic, and just to think, the next one has a higher number than that 61.38%. I have never touched uranium on the channel, and now we see it for a second straight week. Maybe there is something to that. In our top spot at number 1, we have the Horizons Big Data and Hardware Index ETF with a ticker of HBGD. Like every other ETF on today's list, they are based out of Toronto, and they provide exposure to global equity securities of companies that are involved in, well, hardware and big data industry. Their current price comes in at $24.20. They have a NAV of 24.18. Their net assets come in on the low side, 11.22 million. Their beta, quite volatile at 2.65. They have a price to earnings ratio of 25.62. Their return on equity, kind of low at 2.66%, but their management fee looks pretty good at 0.45%. And their dividend, it is on the small side at 0.295%. Once again, it's another semi-annual one, so you'll see it twice a year, that 14.3 cents per share. When we look at their return on investment, though, on the 3-year, their return on investment comes in at 48.19%. Factor in those dividends, we get 50.58%, so that's not too shabby on the 3-year. Now, year-to-date, this is where the story looks really good. Their year-to-date 2003 return on investment comes in at 103.36%. Factor in those dividends, and we get a total return of 104.56%. Once again, we have another ETF benefiting from the AI boost. Enough said. It is hard to argue with these ETFs, as they have proven themselves in 2023. We will have to see if they can continue to dominate in 2024. And from the looks of it, I am thinking there is a good chance of that happening. As usual, if you are interested in any of these ETFs today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on the Big 6 banks linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.